not recognized properly. Because had we recognized, then we would have diversified them into different areas. Right? Our tourism was coming mainly from the Europe and maybe China. And when this Wuhan thing blew up, it was China. And then India was badly impacted by COVID. And we were basically concentrating there as well. So tourism as a whole got impacted, but more so in certain countries where we also had some concentration. So there clearly was a concentration risk in our external segment of the economy, right? Concentration, lack of diversification, non-essential. So there were so many things. So these are the things that were basically impacting. So then from that flows the answer to the second one: comprehensively explain your recommendations to overcome this crisis and bring about sustainable balance of payments and reserve positions. Then you basically elaborate on those issues that you described at the first question. You know, how to basically find solutions to those risks and limitations and weaknesses we found in the first question. So second question is a follow-up on the first one. So if you answer the first question, then the second one is just a piece of cake, right? So that's how I expect you all to basically, now, what have I basically expected you all to do? Think through, you know, give a practical solution to this. Practically identify what the problems were, not the theoretical stuff, right? So most of my questions are like that. You know, you have questions there, or you need
Mr. Boygoda, excuse me.
yeah.
When you say that existed but not recognized, what do you really mean?
Yeah, what I really mean is, see, at a policy level or at a macroeconomic planning level, there was no discussion on diversification and going into various segments which are uh, essential or value additions which make them essentials and so on and so forth, right? So there was complete lack of that type of a discussion even to make our exports more robust and sustainable. Because even today, our exports are very, very vulnerable to these kind of attacks or these kind of events. Because people don't seem to focus on those risks. Risk management is very, very lacking in our country. So much so that we went in and borrowed billions and billions of dollars and we didn't hedge them. We had no natural hedge to them. And we started spending them in rupees. We didn't invest on industries or avenues where dollars were generated because we didn't understand or we didn't recognize that these dollar borrowings have to be paid back in dollars. Had we basically assumed it, or had we basically appreciated that risk, then our policy planners could have, looked at, when you borrow in foreign currency, you on the other side, not necessarily from those funds, but even from other funds, they should have basically increased the export industry or the revenue generation capacity from foreign sources. So lack of that can be basically construed as not recognizing. Did I explain that to you, Niraj?
Yes, thank you.
Yeah. So those are the things. So, it's a practical approach that I'm basically looking at this. There is macroeconomic concepts, but get it on practice. You have to wear the practical or practitioner's hat, right? When I say practitioner's hat, it doesn't mean that you need to be a economist, but even in your day-to-day practicing, you become a practitioner, and if you look at some of these things in that context, then you will understand what the practical implications are. right? So that's what I want. I mean, throughout my lectures, I've been basically telling you, I think from the lecture number 1, I've been basically telling you to concentrate not on the theory and yes, theory is needed, very much needed, but rather than rote learning the notes or the katapadang karna gela began, rather than doing that, when we basically deliver lectures, what you need to understand is the practical application of that, right? How does this how would this theory get practically implemented on the ground? That's what I've been basically asking you to think through. I mean, you can't get to that level in overnight, but reasoning, cause and effect. I mean, I've been using these terms and words continuously, right? That is because when you start thinking in reasoning or root causes or cause and effect, when you think in those lines, then automatically you basically get to understand the practical implications on the ground. And that's why I keep saying, when you read through something, try to understand the cause and effect, try to understand the rationale, try to understand the root causes or the theme behind it or whatever. So those are the reasons why I basically ask you to look at these lectures in that context, because at the end of the day, that's what matters. I mean, there is no other reason for you to learn economics and then, rote learn and katapadang and, cut and paste and, get through exams. Okay. So if you look at it from a very practical sense, these questions are not difficult. This is what I gather. This is what I gather from your answers, your senior student answers. Because all of you have a little bit, or at least a little bit of practical sense in you, right? So apply that practical sense. Don't get scared or anything. I mean, so that's why I was a little surprised when Tarindo said that some of these things are difficult. Because I don't try to, fail you or, give you difficult questions and, get you bad marks, right? But I want you to think from a practical sense. So that is question number 1. Go to question number 2. In a country where economic policies are implemented based on rational evaluation, certainly not in Sri Lanka, consider the following circumstances. The country having a decent reserve position with an import cover of around 12 months. Now you have to basically think, okay, what is the import cover in Sri Lanka? You don't have to memorize those things, right? Those numbers. I mean, you may not know exactly how many months, but if you need to have, as an economist, you need to have a sense, or at least a master student, you need to have a sense that 12 months economic cover, import cover is good or bad, healthy or weak. Yeah?
It's a good ratio. Yeah.
It's a good balance of payment situation, right? Reserve cover.
Yes.
And it is complemented by saying the country is enjoying a BBB sovereign rating. Where is Sri Lanka today?
CCC? I'm not sure.
D.
D, is it?
D.
D,
D for
yes,
donkey.
yes. Yeah.
All right. So BBB, next is A minus. So if you have an A minus, that's a very good rating. So this is one notch below A minus. The best is AAA, but all the A categories are very good. BBB is equally good. And that is a practical application that you need to basically understand. I mean, no one is going to basically give you a lecture on credit rating and AAA and BBB and all these things, right? But I mean, those are very simple kind of concepts that are there all the time in the market, right? Credit ratings. So I'm basically using that BBB sovereign rating and 12 months import cover. Immediately, any economist or economic student should realize that this country is fairly stable. Understand?
Even
What
if
is
the
it?
import cover, I mean, the reserve position runs out, the country can borrow from financial markets. Yeah.
Exactly, because they are triple B,
Yes.
right? So
Yes.
those are the indirect clues that are given in these questions. And an analysis indicates that the country's major export business is losing competitiveness to its region peers due to domestic cost escalation. Now that basically gives you something again. The domestic cost is going up. What does that indicate?
There is a significant inflation ratio within the country.
There is inflation within the country. Exactly. In the global markets, international interest rates are quite accommodative, low single digit. As Western countries are focused on driving high level of consumption to revive their economies. Now, what I'm saying is locally we have inflation, but whereas in the external economy, the interest rates are coming down because they want to expand their economies or they want to basically get the consumption going. So low interest rates overseas, but high interest rate, inflation in the domestic market would lead to what? If you have high inflation or expected high inflation in a domestic market, what would they do to manage
Cost
that
of
high
production
inflation?
will, okay. Cost of production will be high. The other side.
So what do they want to do now? Inflation is kicking in. What is the immediate reaction? Sorry?
The current
Increasing interest rates. Exactly. Right? Because they want to first arrest the inflation pressure. Countries' calculated approach to capital mobility, mostly opening domestic capital markets to inward investments, have recorded positive impact on the economy. What are they saying? The country's capital markets are liberalized, right? In order to boost production, yet prudent in economic management, the country has been running a somewhat upper bound middle single digit interest rate policy regime during the last 2 years, which have shown progress in meeting expected credit growth. Simultaneously, inflation expectations in the country is picking up steam and threatening to overheat the economy, and the SPI has been northbound for some time. All share price index is going up, right? Because interest rates were low. All this while interest rates were low, so therefore there was demand for equity, right? So therefore, since there is demand for equity, the all share price index is going up. Oil imports is a substantial commodity of the import basket of the country for both power generation and transportation, but the recent ADB-funded domestic rooftop solar drive, along with tax reductions for electric vehicles, is paying dividends in reducing the fuel consumption. What does that mean? Even though oil
import bill is getting lower, probably.
lower, on top, the country is also blessed with good monsoon that enabled majority of the hydropower reservoirs reaching its capacity. That means your power generation is now even low cost. So power generation is low cost. Your import bill is basically coming down because of oil imports. So they are in a good wicket. Because of that good wicket, monsoon is good, harvest will be good. So even though there is a certain amount of inflation pressure on the one side, the future is going to be positive for the country because your energy costs are going to come down, which is threatening at the moment, but going forward, when electricity or power generation costs come down, your cost of production will be positively impacted, and so on and so forth. Right? Now, taking these things into consideration, describe the country's current macroeconomic environment. Now, we've been basically discussing it all this while now. 12-month imports, the balance of payments, all that, right? But the only negative in the context of classical economics is that inflation is economy is tending to overheat. So you can basically explain the economy on all these fronts and also say that the economy is threatening to overheat. In the immediate threats lurking in the economy, what is the policy prescription they should implement, and why do you think such policy effective in addressing threats? Absolutely simple, no? They can.
I'm sorry.
Go ahead. Ask.
No, I was just thinking like, I think most of us here would be able to, without by heart in the notes and all, explain these situations in layman's terms. So will that be all right with you?
Of course.
Right.
I talk layman's language. No, I also don't know some of these, very, very complex theories. Right?
Oh, okay. So thanks.
Then Sri Lanka is going through severe financial crisis. Consider the following hypothetical scenario. Impact in the financial sector. Country's rating is default. Country's rating is in default. Most local banks perceived to have weak foreign currency credit rating. Few local banks with strong parent support have strong credit ratings. Foreign banks have restrictions in transacting with weak banks. I mean, we went through this in our swap transactions when we were learning swaps, right? Foreign borrowing, swap into Sri Lanka rupees, through a forex swap, and then, reducing your cost of borrowing. Some can reduce your cost of borrowings, but others can't, and how you basically make arbitrage interest gains and things like that. So this question is basically going towards that. Market information is given, spot trade, buy, sell. Interbank market trades, the yield curve is given, 17.5. I mean, this was in 2021, right? So that's why these rates were given. So the yield curve is given, spot is given, sell by rate, or buy sell rate. Then we have given certain conditions, A, B, C, and D, includes foreign and local banks, are strong banks. A, B, C, and D are strong banks, and the applicable forward rate for an FX swap, because at that time there were two types of forex rated forward rates quoted in the market. It was a very peculiar situation. The highly rated banks were basically trading at a different forward rate, especially the foreign banks amongst them. But when they quoted to the local banks, because there was a crisis situation, their forward rates were very, very exorbitant at that time, right? So taking that into consideration, the rest of the questions are asked here. Explain how a forward premium are computed in an interbank market. The simplest question I can ask about forward rates, right? We've gone through it, interest rate differentials and things like that. And then you basically add or deduct a premium based on demand and supply, right? Now that is somewhat theoretical, but I mean, to you it's theory, but for a practitioner, it's the simplest form of computation. That's why I give only 2 marks for that. From given data, derive the interest rates applicable for the 2 groups of banks. So once you understand the, buy-sell rates, now swap rates are given here. See, in the ABCD group, swap rates are 5 cents per day. Then for 30 days how much, 90 days how much, 180 days how much, and 360 days how much. XYZ or WXYZ banks, which are the weaker banks, the forward premiums are negative 5 cents. And when you look at negativity, then you understand what happens to the rupee interest rates, right? So using negative 5 cents per day, then you compute what the sell-by interest rates are, or buy-sell interest rates are through buy-sell swaps or sell-by swaps. And we have done these questions in the class, right? So that's weaker set of banks and stronger set of banks will have different interbank lending borrowing rates that you can compute through the FX swap route. And we have basically gone through those exercises, right? And gone through those sums as well. I told you to go through the sums, do the sums yourselves and practice. If you do that, this won't take more than 5 minutes for you to answer, right? If D is able to deal with ABC and W, what is that? D is able to deal with the strong banks as well as weak banks. Then what does the natural advantage he has?
Arbitrage opportunity.
Arbitrage opportunity. That's what I'm basically asking here. And then compute that arbitrage. Right? And how can anybody say these are difficult? If you follow the lectures, if you do the practice questions, all what you need to now do is convert that sum into a real life situation. I think when we did that, also we went through that real life situation when we went through those questions. Right? Under normal market conditions, how would the marketplace react to such opportunity? As mentioned in C above, explain how the market correction would happen. If there is an arbitrage opportunity, how would the market correction happen? Right? If there is a demand at a high rate, then suppliers would basically increase. When supply increases, the arbitrage opportunity decreases. I mean, that's a natural thing, right? Even like when there were shortages or when there was a very high demand for turmeric, can you remember during COVID time, turmeric was considered, I mean, even now it is considered as a, what do you call, disinfectant, right? So during COVID time, there was a huge demand for turmeric and turmeric was in short supply. Then what happens? That's an arbitrage. There is an arbitrage opportunity of excess profit making without additional risk. That is what arbitrage is all about, right? So then it took a little while, but people started cultivating turmeric, lock, stock, and barrel. And then supplies increased and the profit margins dwindled to a situation where some of those fellows couldn't even sell their turmeric afterwards. Same thing happens in these kind of an arbitrage situation also. Arbitrage opportunity exists because there is a demand which is exorbitant. Because there is a crisis and this bank must be extremely short in their funds. Therefore, he is willing to pay anything and borrow. Then on the other side, there is a glut of money and they are supplying funds, but they can't deal with this chap who's borrowing. That's where this middleman comes and borrows from the low cost side and lends to the high cost side and makes a decent profit in between. That is arbitraging, right? Without taking any additional risk. Now, when this thing happens in a market, there will be more than one player. There will be more than one person as D. Then they will start doing this transaction more and more. And then the arbitrage opportunity will basically diminish. Okay. What are the bank market avenues available to DE? I mean, once you understand this whole thing, you will be able to figure out what the rates and I mean, it's basically borrowing from 1 and 10 degree. Yeah, go ahead. Yeah. Yes. But that's why I'm basically saying under normal market conditions, how would the market players react in such an opportunity? Because if there is only one guy, that is not a normal market condition. right? Understand? So these are the little nuances. See, these are the little nuances that as economists you need to basically understand. You're not undergraduates, no? You're not A-level students. So these little subtle things you need to be. Perhaps those may be the ones which you feel that make these questions little difficult. But at your level, I shouldn't be spoon feeding, right? I mean, normal market condition is normal market condition. Any economist should know that. Yeah. So that deviation comes from this phrase called under normal market conditions, right? What are the bank market avenues? Then what are the factors that enable D to generate LKR funds at favorable rates as computed above? What are the factors that have enabled D? Why is D differentiated from W, X, Y, and Z? W, X, Y, and Z are considered weak banks. D is considered a strong bank, and that is why A, B, and C are willing to deal with him. So what is the, so then you have to think, okay, D is local, but he's different to the other local banks. Why? Does he have a good name? Does it make a difference? Or does it have a good looking manager or CEO? Does it make a difference to ABC banks? Then what is the differentiating factor? What would differentiate D to get better, pricing as against the other local banks? What is that single factor?
Probably there are multiple factors, like it can be an arm of a foreign bank which has this abundant foreign reserves,
Okay.
or like its balance sheet is more robust compared with the other banks, and their levels of, would say, I mean, probably the capital adequacy ratios and liquidity ratios are higher than the other banks.
Exactly. What are you basically talking about now? The risk profile, right, of that bank.
Yes, yes, yes.
So then if it is risk, then you expand on that risk and say, okay, they have a good capital buffer, they have a good, client base, their NPLs are less, and so on and so forth. Right? So maybe that is the reason they are very selective in their lending policies, they are very transparent, governance is very good, risk management is very good, because those are the factors which contribute towards a better risk rating. Now, I necessarily don't expect you to go into all that detail, right? But at least if you can basically say, okay, this is because they have a good risk profile, that might suffice. And if you add a little bit more, that's even better, right? So it's all to do with, so far, everything that we have discussed are practical, right? Now, these other last 4 questions are mine. Mine were only the first 3. Right now, you can go through the others and figure out, I mean, how the others basically test you. But first 3 are the ones that I basically contributed to this particular paper.
But this time you will be compiling the whole paper, right, sir?
Yeah, because I am the only one who taught, right?
Yeah, that's what I was thinking also. So 2021, there were 2 lecturers, was it?
Yeah, I think the other part was handled by this balance of payment theory, and all that was handled by another lecturer.
Right.
So you can expect an extension of these kind of questioning on that side also.
Okay. So basically what I figured is, right now, after the discussion of this 2021 paper, like practical banker with some kind of an experience in the market will not have a problem in answering this.
No, that is only because I was basically asking banking questions now. But there are balance of payment questions, there are risk management questions. There are, but I mean, in international markets, international markets will be a lot of. Then there are investments, FDIs that we talked about, right?
Yes, yes.
So that's basically, and also, so that we'll go on to another set. Now I have to be very careful not to open the question bank that I'm basically planning to give you all. Yeah, you guys will take a print screen and then you will have all the questions. Yeah, so this is what that particular 2021 is. Let's go to 2023 and see.
2023 is our batch, like I think it's 2021 paper, is it?
No, what I showed you was 2021.
Ah.
Because in my language, I consider you as 2024 because I teach you in
Right. Yeah.
Right. So this is 2022. I don't have. Can you see the new one? Or you still see the 2021?
Still see the 2021. Sir.
Okay. These are some questions last year. In analyzing financial crisis countries have faced thus far, there are a few root causes that emerge as contributing factors, such as such crises explain how the following factors would create economic stress in a country, leading to a financial crisis. Here we are basically talking about Asian crisis, ruble crisis, and so on and so forth, right? We went through, I wanted you to read through them. We wouldn't have gone through it in detail. Did we go through it in detail? The Asian crisis, Latin American crisis, ruble crisis, and so forth. I think I wanted you all to read up on that, right? It's important because, see, some of these things you can read and understand. You don't need the explanation, right? Anybody can read an article on Asian crisis and figure out, because that article will explain the whole thing. This is why it happened. This is why it didn't happen. This is how they came out, and so on and so forth. Right? So that you need to do you are not advanced level students or O-level students. You all are master students, postgraduate students. You need to do your reading. You are reading for a master's. You're not studying for a master's, right? Usually that's how we basically say we read for degrees. So you need to do the reading, and that will basically give you an understanding. And then the context is, I'll give you the context, then you will understand the line of questioning also. It doesn't mean that I will ask questions on these areas. But see, when we basically approach the forex side, the swap side that we were talking about, we were looking at how FX can be used, or FX derivatives can be used for fund generation, right? And in doing that, if there are certain risks that arise, how do you manage those risks? For instance, you borrow from overseas. That's a forex transaction. Foreign currency borrowing transaction. Sorry, it's not foreign exchange sell and buy. But first you borrow the dollars from overseas. You get exposed to repayment risk, right? You need to make sure that you have the sufficient dollars to pay back. Then you can't use the dollars in Sri Lanka. You need to convert them into rupees. Now, you can convert them in two ways. One is just sell them, then you have rupees. You use them. Using means you can either, if you are a bank, you can lend them to customers. But if you are a corporate, you can use those rupee funds for your capital expansion. Then, when it comes to payment time, you need to now buy back the dollars using your rupees and pay the foreign borrowing lender. And in doing that, you need to basically buy it at whatever rate that is available at the time. So the difference between the original sell transaction and the later buy transaction, there will be a cost difference, and that cost difference basically gets converted into an interest cost. That's how we basically look at that interest cost in a swap, right? Or else you can do a sell buy on day one itself, a swap. Then what you do is you crystallize your buying rate. Otherwise, you have to wait until the period is over, and whatever the rate, you have to buy, right? So therefore, in the first situation, until the last day of buying the dollars to pay back, you wouldn't know what the cost of your rupee generation was. You are exposed to the entire market. Is that a risk or not?
It is, sir.
It is a risk because you can't control the rest of the costs because you don't know what your rupee conversion cost was. So if you are basically using those rupees to do a business and get a return, you wouldn't know what return to get because you don't know what your cost would be on converting your rupees to dollars. Dollars to rupees. So that's a huge risk that you're running, a gamble that you're running, and people do. Not all do swaps and hedge their exposures, right? Because we are Sri Lankans are a bunch of punters, you know. We are very good at punting. I mean, we punt at elections also. We don't hedge our bets. We just go and jump into the bandwagon or the deep end and get completely beaten. We did that in 2019. I can see that happening in 2024 as well. You don't analyze, you don't do anything, you just go with the trend. If your neighbor says I'm X, then I'm also X. That's the kind of approach that we have. So we go from one extreme to another and get into another hell, right? So likewise, there are many people who don't look at these financial transactions also from a hedged, cost-controlled manner. That's why they basically sell the dollars and hope for the best when it comes to repayment. Classic example is what happened to us as a country also, right? We didn't have neither the price nor the liquidity hedged. If you hedge the liquidity, that means we would have basically invested our borrowed dollars in rupee prices, which could have generated dollars. So then your liquidity generation is hedged through those export industries. We didn't do that. And we didn't know what the price was in the future. We never swapped them. We just sold them, sold the borrowings. So the alternative is to swap. And if you swap the dollars, then on day one itself, you know what the buying price is. And through that, you'll be able to compute your rupee conversion or rupee liquidity cost is. When you know that, you know at what rate you should basically on lend or you should invest to get a positive return. Now that second method is called hedged conversion. That is the hedging part. So you have a dollar borrowing part, then you have a hedging part. Hedging part is a FX sell and an FX buyback or FX swap. And in combination, you have a complete end-to-end hedged transaction. Right? So that's one. So when analyzing financial crisis, so you need to basically understand what this. So what I was basically talking about is on that particular transaction, the borrowing cost, the liquidity generation, whether you are hedged or otherwise, right? Those are the things. I mean, those are the practical aspects. In a financial crisis kind of question, what are the things that we want to basically take home for our own consumption? We need to look at those financial crises that happened in the world, try to understand what are the root causes, what remedies were applied, and how did they or did not get out of that situation. Then you compare it. Why is it important for us? Because we are also facing a similar situation. In the future also we can get into a similar situation. So learning from what has already happened, right? And if there are successful remedies, can those remedies be applied in our context? Have we done that in our context now? What have we done? Are they short-term superficial or long-term robust? So all these things could be understood when you study the financial crisis that have happened elsewhere, but in a proper context. You need to understand, you have to study them in that proper context. Otherwise, you will not get it. Right? So what we need to, why we study financial crisis in Asia, does it matter to us? Yeah, it does. Because we can learn from it. What are we going to learn? We are going to learn how that crisis happened, how they get out, how did they get out of it, and what is the relevance of that crisis to our crisis? Is there a relevance? Right? Are these two comparable? If they are comparable, then the remedies also could be comparable. And that's the reason why we study that. Otherwise, what else? Why else would we study about other financial crises? To go and punish Mahathir Mohamad or Lee Kuan Yew? Huh? Right? So you need to basically, as economists, also figure out, okay, why are these things being taught? So that's the reason you need to study. Then explain how the following factors would create economic stress in a country leading to a financial crisis. Fiscal imbalance. What is a fiscal imbalance? Your income is much less than your expenditure. Your tax rates are so low and your government expenditure is so high, you have a huge budget deficit. How would that basically lead to a financial crisis? Then, unsustainable BOP practices. What are sustainable BOP practices? What is an unsustainable BOP practice? Balance of payment practice.
Fixed
What is balance of
exchange rate here?
Okay. Yeah. Go ahead, please.
I know what I was referring to was we had maintained a fixed exchange rate policy here, and that has depleted the foreign currency reserve of the country.
Yes. Right? That is one of the practices. What was the overarching practice that we got all of us into this trouble from a balance of payment side? What does balance of payment mean?
Overconsumption.
Sorry?
Overconsumption
Overconsumption of what?
of imported materials.
Yes. So exchange rate regime is one, because exchange rate regime is a remedy to create that balance or imbalance. Right? But the overarching thing is that we live beyond our means as far as our Dealings with the external factors were concerned. External sectors were concerned. That's unsustainable BOP practices. We borrowed from overseas, spent on various things locally, which were not generating enough dollar revenue. Bad BOP practice. We were exporting 1 million and importing 1.5 million. Bad BOP practice. Right? Likewise. Then liberal capital account policies. How would liberal capital account policies impact an economy? Maybe not in Sri Lanka, but this question is not about Sri Lanka, right? What would happen in liberal capital account policies?
Capital mobility will be high, and in case of an issue or some downward trend in the markets, the whatever the FDIs in the country will start flowing out at a rate.
Exactly. Right? Then greed for growth combined with lack of appreciation for risk management. This comes straight off the book of Malaysian crisis. Oh, yeah, it's Thailand. Greed for growth. Borrow overseas. I mean, it basically goes very close to our 2010-2015 era as well. Just to show that we are growing, our GDP growth was 10%, they boasted. What did we do? We brought in dollars and basically pumped it into highways and this, that, and the other. Yes, they are good, but never concentrated on repayment capacity. Right? Greed for growth combined with lack of appreciation for risk management. So risk management part comes in repayment capacity, exchange rate, exchange conversions, all that. This happened in Thailand. That was the crisis or the root cause of the crisis. They had, I think in Korea also they had this problem. So read them up and see. Then you will see that these things happened elsewhere, which can be basically applied to our case also. Then you see, okay, fine, can you have some remedies which they have followed? Can we have similar kind of remedies in our country as well? Learn from the mistakes and learn from the solutions. You don't have to reinvent the wheel if there is a similarity.
Just about this greed for growth, sir, like, I'm sorry. Just about when we discuss about this point D, greed for growth, like it's you're in, I mean, most of the instances that I've seen, like the speculation comes in, right?
Yeah.
Because this Irish property bubble and all, that was the,
Yeah. So that's why it's very, very important to study comparative issues. You know, in most of the foreign universities and all, they basically, that's why they teach through this, what do you call, case studies. Right? Because your theory can be applied in these case studies and see how they, you know, go hand in glove. Then you say from A, D above, identify the main factors that contributed to the economic crisis faced by Sri Lanka. So you're basically now bringing that understanding in the foreign jurisdictions into Sri Lanka and saying, okay, what went wrong in our case? How can these kind of questions be difficult? This is my question.
Wrong assumption on my side, sir. Sorry.
No. I mean, some people might find them difficult if they expect the lectures to be basically, you know, questions to be asked where you can basically cut and paste the lectures using cause and effect. Yeah, I've been basically saying this. Explain how major factors could contribute to the determination of long-term exchange rate of a country. Now, this is straight off the textbook. When I give questions, I consider some of those aspects as well. Okay, you memorize and then you do a cut and paste. You know where this is, right? We did this in detail, this exercise. Why do these factors fail to determine the exchange rate movement in the short term? Then you have to apply a little bit of practical knowledge to it. Why would, let's say, improvement of efficiency, which basically impacts exchange rate in the long run, would not have an impact in the short run? Because improving efficiency is a long drawn process to bring down cost of production and then make your domestic production competitive. And through that, you basically increase exports. And through those increases in exports, you basically bring in more dollars into the country. And when more dollars come to the country, your local currency strengthens and so on and so forth. Right? So that's the application side of it. Long term and short term. Explain how the short term rate movements are determined through demand and supply functions, citing the applicable theories. Again, that's a very straightforward question. Then this is another situation where you basically by heart policy trilemma, then you can basically figure out, okay, what to write. Explain what is meant by policy trilemma in financial economics. It's a kind of theory kind of thing, right? There is a discussion in certain segments of, I mean, again, we are going back to 2023 or 22. Political economic circles, Sri Lanka, we should adopt the Indian rupee as the legal tender. Remember, there was a huge discussion about this. Whether we should use Indian rupee or some other currency as our tender when we were going through the deepest economic crisis that we had ever faced. You know, rupee was basically going towards 400 and so on and so forth. Remember that period? Then economists were thinking of, you know, they were talking about Indian rupee as a legal tender in Sri Lanka. Remember that?
Yes.
Yeah. So what were we effectively talking about? From a theoretical angle, what was it? Is it a floating exchange rate regime? Fixed exchange rate regime? Pegged exchange rate regime? What's it?
Peg.
It's a peg. Peg to the Indian rupee. And it moves along with it, right?
Is this the same thing about, I mean, my understanding is that currency boards are different to this, and there was a discussion about that.
Currency boards are also very similar.
Right. Because that discussion was also there, no? So that's why I called.
Yeah. In terms of exchange rate regimes, what is the similar to fixed, floating, or pegged? Critically analyze the positives and negatives of such a move, providing applicable scenarios. If you peg your currency to some other currency, then what happens to you, to your economy?
You'll have to move along with that economy, like when the inflation goes, like the say whatever the policies that is adopted by the central bank or the reserve bank in that particular country, we'll have to follow that as well.
Exactly. So we lose our economic independence and maneuverability. So even if our inflation is very low and our pegged country's inflation is very high and they increase interest rate, then to keep the peg intact, we also have to increase our interest rates. Then what happens? When our inflation is very low, what should we really do? We should lower the interest rates to expand the economy. Yes. We need to have a little bit of inflation in a country, right? When you are growing. So despite the fact that we have all the precursors or all the conditions for a low interest rate regime and expansion of an economy, when we are pegged to a currency, we have to follow their policies and their actions, regardless of what we want to do on our own. So that's one of the biggest negative impacts. But on the other hand, it basically stabilizes an economy because volatility is basically taken out. Because you don't go and peg to another basket currency, you will basically go and peg to another stable currency. So in that situation, your volatility drops, and when your volatility is reduced, your predictability increases. When your predictability increases, people get into more and more businesses, because predictability means your uncertainty reduces, your certainty increases. When your uncertainty reduces in an economy, investors are willing to invest more. So that's how the opposite works. Again, cause and effect. Okay, let's go back. Again, it's similar to what we have been discussing. A local bank who is able to borrow US dollars from an international bank, blah, blah, blah. The A, B, C, D, and W, X, Y, Z. The question has got repeated, kind of. What are the key risks that exist in finance? Briefly explain market risk management framework. Straight off the textbook. What are the key risks that exist in the financial market? Briefly explain. I have given only 5 marks for that because you could have memorized it and cut and paste. Assuming you have a financial advisor, explain how you would respond to a customer who would come for an investment advice from you, who intends to invest his funds in the long term. You have the following information at your disposal. You have this, so this is the information that you have. Based on this information, how would you advise an investor? Now, the second question is, how differently would you advise him if the customer was a borrower? So all these factors will basically lead you towards forecasting future exchange interest rates. The conditions are given here. They will basically come with inflation or stabilization of the economy or whatever, which will have an implication on interest rates. So you need to basically, while reading these bullet points, you need to figure out, okay, how would these factors contribute towards either inflation or deflation or interest rates or whatever, and then respond accordingly, right? If you realize the customer has already borrowed funds from a bank, right, then depending on which way the interest rates are going in this bullet points, you have to figure out what is the hedging instrument that you can propose to him. All practical questions, right? Here you have a little bit of economic. So the crux of this is you need to understand economic theory to forecast the outcome of an economic factor. So there are practical, on the ground, factors here, and you need to convert those factors into an economic theory and figure out what would happen to those major economic indicators if these conditions prevail. From that, you basically develop your solutions. That's this question. Okay. So the next one is, again, giving a scenario. The number, the point B has basically dictated a scenario to you. And if the customer is in a negative position, then how would you basically remedy that negative position? If the customer is in a positive position, how would you protect that positive position? That's the risk management angle that has come into this question. These are all, I mean, you don't have to memorize any of them. If you understood your lectures in a practical sense, then you can answer this question. Define the term balance of payments. Briefly explain the main theories of balance of payments. Theory, cut and paste. Explain any 4 of the following statements taking BOP impact into account. A wealthy individual in Sri Lanka one may be able to afford expensive imported goods and foreign vacations, but as a country, none of us are able to afford such luxuries. Domestically, I may be earning a lot of rupees, and we are saying, so I'm in my own right, I'm very wealthy, but I can't afford I can't afford imported goods or a foreign vacation, because as a country, our position may be very different. So what is that difference? So you explain me. You know, you may have a huge domestic economy, and we will be very good. We are all very rich in our own currency, but we are very poor in our external revenues. That's what this internalizing of whatever theory, self-sufficiency. You get into a hole and live like, we are the kings in this hole. But there is a very vibrant world outside, but we can't afford that world outside because we don't have the means to go there. We are very rich. So if you decide, okay, that's our desires. I mean, we don't need to go, we don't need to consume foreign goods. We don't need to go overseas, look the world, see the world and all that. Well and good. You live a very comfortable life. You're content with it. That's fine. That is one theory or one way of life. So it all comes into balance of payment. And when you are explaining that balance of payment, you can say that. If you are content with what you have locally, you have 3 square meals, you manage your health with local medical practices and so on and so forth. So you're fine. What else do you need? I mean, you have all the local material for your dwellings. Transportation, I don't know how you do that. But figure out a way of going from A to B without walking. Right? So all that, if you can figure out that model, that's fine. So you will be very happy locally, and you don't need to basically consume abroad. But if you want to consume abroad, then there is a different set of requirements. Just by simply being wealthy in Sri Lanka is not going to help. Then what is it? Why is that? How would you, or rather, what causes that difference? As a country, we may not be generating enough foreign currency income. That's why we can't basically afford our citizens to have foreign currency expenditure. Yeah. Regardless of the channel through which foreign employment earnings are remitted to Sri Lanka, the beneficial families will always have a decent income of living. But informal channels, I mean, this was again relating to Undial and Hawala and things like that, which were quite prevalent. I mean, it is prevalent even now, but then that was the main channel through which money was coming into and going out of the country. So then what is the downside of that channel? Money is coming into the country, but if it doesn't come through the official channels, how would that impact our rest of the living standards? So increasing, then how would Sunday invoicing and holding money outside the country, will that, how would that impact? Even though exports are thriving, if you do under-invoicing and holding money outside, then we are back at square one. That's, how do you explain that? So we are very famous for gemstones. If they go in the smuggled way out, will we benefit from that? As a country, are we benefiting from our this treasure trove? If not, why? And so those are they are all balance of payment issues, right? Now, Did you ever think gemstones will become a balance of payment issue? We are very rich in gemstones, right? But our balance of payment is very poor. Why is that? Just think about it. Then you will figure out what is the root cause, what is the problem, what is the remedy that we can, implement, and why is it not being implemented also. So likewise, you need to basically explain these observations using cause and effect analysis. Difficult? Is it difficult? There are 30 students in the class. What are the questions? What are the difficulties you have? Tell me. I mean, because I don't want you to be scared of this whole thing. Because if you look at them, the approach is very simple. I mean, I'm asking very simple questions. Or at least that's how I look at them. Ravindu? Niranj? Harindu? Oh,
Yes,
good.
I only said it was difficult, but I think I haven't gone through the past papers properly, so I have some confidence now on this.
Yeah. How about the others? That's only Tarindu, right? How about the others? Yeah. You can't do that. You definitely cannot do that. I mean, there will be one or two sub questions within that paper where you can cut and paste answers, but majority will be where these are very simple things. Only thing is you have to wear that practitioner's hat. When I say practitioner's hat, it is not a treasurer's hat or anything, or a banker's hat. A practical man in the economy. You wanting to have a luxurious car, you are just another individual in the economy. And then you basically start thinking, on the one hand, can I afford this? On the other hand, can the country afford this? So for that, you don't need to be a banker or treasurer or forex dealer or, you understand? But only shift that you have to make is using that knowledge you have on forex and balance of payments and all these things, you start thinking in practical terms. What actually happens when I buy a motor vehicle? And that practical aspect, is it doable or not? If it is doable, why do I think it is doable? Then you will realize, even though I thought it was doable, it may not be doable. So you need to basically start looking at it in that context. Yeah, now, just to give you some hints on so we were basically covering, like if you look at the areas that we covered during our lectures, I think with you all, I covered few things more than, I added some topics when I conducted your lectures. One is, of course, I basically went into that whole discussion on balance of payments. the theories and, the absorption theory and elasticity theory and all that. We went into a lot of areas where it was practical, it was impractical, it was critical. There were critiques about those theories, why it was not, what are the issues with those assumptions. So they are all, part of that practical aspect. Then we were basically looking at, of course, we discussed also where these borrowings and foreign currency borrowings and how the swaps work and things like that. So then I basically got you to read on the financial crisis in the world, and we discussed it as well, right? How it is basically applied in the Sri Lankan context. Those are things that we anyway had done. Those are not additional stuff. Then we were basically, discussing about the balance of payments, the health of balance of payments, what is a healthy balance of payment, what is an unhealthy balance of payment, and so on and so forth, right? We looked at the composition of the, reserve account and what are the factors that make balance of payment stable. What else? Then we basically we discussed about sterilized intervention, non-sterilized intervention, and so on and so forth, right? How that works, how they go through. So, what is the practical aspect of it? When there is a crisis, if there is an intervention by a country, what could go wrong through that intervention? How can we basically stop that or avoid that disaster or negative implication? What are the tools that are available to central banks and things like that? Now, again, this is at a policy level, but it's a practical thing, right? They do it all the time. Countries intervene in the market now these days. If you look at Japan, the yen rate is, going through kind of not necessarily all-time high. I have seen 180s and 200s also I have seen to the dollar, but mostly it was in the lower hundreds, 120, 117, 120, that area, or 25, 30. Now it is around what? Yen rate is around, yen to the dollar is about how much? About 160, 165, that level, right? So that means it may have basically devalued more than what they wanted. So then you can basically see some intervention coming in if it is detrimental to the Japanese government and so forth. So you need to basically figure out what are those possible scenarios and things like that, right? So that's the practical application side of things on those kind of interventions. We talked about what are the other things? We looked at cross-border capital flow, right? FDIs, foreign direct investments, foreign portfolio investments, right? And then we looked at derivatives, hedge funds and things like that. So we looked at the whole gamut of things, right? Then we also looked at, what are hedge funds? What is the other one? The equity capital markets, debt capital markets, asset management companies, then hedge funds, and so on and so forth, various investment products, right? We looked at, how to build a stable portfolio. What are the, factors that impact portfolio performances? We looked at, diversification as a risk reduction and so on and so forth. Correct? Then we also looked at various, hedge fund strategies. We looked at, long, short investment strategies and so on and so forth. We did a case study on, I think, one of those. And we looked at something going wrong with that. In that case study, we looked at something going wrong. That is a practical thing. Now, then we need to basically figure out, okay, what are the salient economic features that were in those kind of situations and so on and so forth. You can link your market case study into macro theory and basically understand what went right and what went wrong. Yeah. Then we talked about portfolio diversifications and things like that. How to build a optimal portfolio. How they use empirical data, right? Because sometimes no theory can explain some of these, correlations, but empirical data will show you certain relations, negative, positive, etc. Then you have to apply your economic knowledge, international economic knowledge, to figure out, why would US and Netherlands have so much correlation with each other, right? Any economic news hitting Germany will have an impact on Netherlands and so forth, right? We saw that some of those correlation numbers and things like that. Then we should be able to explain them in layman's language, right? So then, if you want to diversify your portfolio, is it worth diversifying it between Germany and Netherlands?
No.
Exactly. So this is all. Yeah, go ahead. No, I'm just going. Yeah, that's what you're saying, but I'm just from the top of my head, I'm basically taking you through some of the stuff that we had done. I need to basically. I just made some small notes on the topics. It is not on a paper; it's on my phone. The areas, so that's why I can't share it with you. Like the topics that we did, the FX swaps, we did FDIs, and so on and so forth, right? FDIs, I think I gave you an assignment for you all to basically look at how FDIs have basically helped various countries. And then, so that's again a practical approach. Then, what else? Yeah, we will did a lot on this cross-border investments, cross-border finance, various instruments, looked at various instruments and so forth. And when we were building portfolios, like investors always build portfolios and they need to basically look at risk angle, risk reduction. And that's when we basically started talking about correlations and diversification and stuff like that. Right? What correlation do? What diversification do to a portfolio? I mean, those are very practical stuff. We need to be familiar with those kind of things and convert them into practice. Then we were also looking at domestic diversification versus international diversification, and how different geographies, different countries will have differences in internal versus external diversification. Who benefits best through international diversification? Yeah. So then, say suppose if one country is getting a better risk reduction through international diversification versus the other, which doesn't get that much of a benefit, then is it worth going out? Because if in-country diversification can reduce your risk to a substantial level, then why would you want to basically go out into an unknown country? I mean, these are the kind of questions, right? Then, so that comes from that. So those kind of conclusions come from those theories of, diversification, correlation. Now, correlation is, you need to, I mean, theoretically it's correlation, but then you need to do a empirical analysis and see what the real correlations are. And then only you come into, certain decisions after looking at those empirical data. Right? Yeah. Then you have the balance of payments, you have this. Yeah, those are basically what the coverage is. I have basically taken you through the entire thing. Anything that we have missed, let me go to the. Okay, here we are. Yeah. Can you hear me?
Yes, sir, we can.
Yeah, so this is basically a course content. So, yeah, then we basically looked at how FDIs would move from country to country. What are the factors that entice investors to go from one country to the other? Is it only tax breaks, or are there any other factors that investors look for? I mean, there is a theory around it, but practically also we can see what's happening. I mean, why have we not been able to attract FDIs into this country for a long time? What are the detrimental or negative factors we have in our economy? And these are all practical again. What need to be done about it? I mean, how can we basically change that and make this destination investors' paradise or investors' preferred destination? But in doing so, are there any, should we just go whole hog and get everybody come into the country? Or is that the way we want to proceed? Or do we need to basically be, cautious? Should we stop it altogether? So when some of these questions will not have a definitive answer. That also I have basically told you. Some of these things will be decided by you. The answer will be decided by you, to tell you very frankly. Because when I structure the question, I may not have an answer because my answer is my view. Right? But you need to basically your own view and explain that. In explaining what I expect, the standard that I expect from you is what matters. Right? As an economist or as a postgraduate student, I expect you to basically provide me a rational answer. You can't just say, I don't like FDIs because I don't like their face or whatever. Or there are, Western countries coming here to exploit us kind of nonsense. Right? You need to basically elaborate and show them, okay, fine, this is how they have performed in the past. They have never gone to a country and, let the country develop. If you can prove that, then I can expect or rather accept the answer saying that, okay, FDIs are detrimental to an economy. But if world has seen many countries where foreign direct investments have basically helped those countries to elevate themselves, then your argument of them, they are the bad boys in the world and they always do bad things, will not hold any water, because there are countries in the world which have benefited from those capital inflows. What have they done differently to the others? Some corner of the, we can't consider Africa in the wilderness anymore because they are much better than Sri Lanka. But some country which is highly corrupt have basically attracted the wrong investors and got into trouble. That doesn't mean that FDIs are bad. That means that you have basically attracted the wrong fellows because you are very attractive to them, to the wrong fellows. Right? So these are the things, these are again, practical approaches that you have to think through. Not difficult. But what I'm saying is, if you have a strong view and you can basically cement it with facts and figures, you can always make that your answer, and I will basically respect that answer. But it has to come with rationality, cause and effect analysis, and so on and so forth. You need to basically convince me, in other words. Yeah? Even if you are basically saying the same thing that I am convinced in, but if you are giving a half-baked answer, then you will not get full marks. You will get marks only for the amount that you have described. So from a postgraduate student, I would expect you to be fairly liberated and give a rational answer. So that's on what? MNCs, FDIs, all these. Why would MNCs move from country to country? What is the rational thinking of theirs? What should we do? If their rational thinking is detrimental to ours, then how would we basically respond to it? And so forth. I think we looked at those areas, and they are interesting areas. Then, of course, we went into these international financial systems and crises and things like that. We looked at the rate regime. We discussed about it. Forex transactions, we went to a lot of detail. We looked at the rate determination, exchange rate, or rather markets, rate determination, theories. Yeah. And we discussed about some questions on those areas as well. See, I'm not too much bothered about this. I mean, market terminology and all these things you need to basically be familiar with, but they are not testing material. That doesn't mean that you shouldn't learn about them and forget about it. You need to know what is a spot, what is a forward, what is a swap, and all that bid offer spread, because that's something that you are going to use in your day-to-day activity. If you are dealing with a bank, whether you are in a bank or otherwise, you need to know what these things are. If somebody gives you a spot price, then you know that it's not the cash price, right? So that's something that you need to basically have in your own this thing. But it doesn't mean that I'm going to test you what is a spot and what is a forward and that kind of thing. That perhaps for grade 8s, 9s. Then we looked at risk management also. If you go into that, then balance of payment theories. We talked about balance of payment crisis from a Sri Lankan context. And there are lessons to be learned. And let's yeah, we have 15 more minutes. By any questions that you need to basically ask me? Any areas that you have studied but not understood properly? What would be a question from here? You can ask about the theories, market seeking, resource seeking, blah, blah, blah. But what is the practical side of things? Okay, these are the things that they look for. But on the other hand, what are we offering them? What are we aligning with? Are we able to give all these things? Do we give all these things? If you don't give all these things, what are the ones that we give them? Better to attract them as against certain things that we can't give them. Like say, for instance, would investors come to Sri Lanka seeking markets? Now, investors go to India because foreign investors go to India because India has a large domestic market. But do they come to Sri Lanka for that large domestic market? No. That's a practical thing. The theory basically says, okay, market seeking, resource seeking, efficiency seeking, strategic asset seeking, blah, blah, blah. But in reality, our neighboring country attracts FDIs in a different way that we can't replicate that same thing in our own country. Then how would we basically position ourselves against their requirements? So first we have to understand their requirements, and then we need to be able to figure out, okay, what are the things that we can provide to them? That's the FDI strategy that we are talking about. Right? I think we do have that kind of a thing somewhere buried, but whether we are actually implementing it practically, I have my doubts. Right? Then efficiency seeking is one. Are we offering efficiency in Sri Lanka?
No.
Huh?
As far
Why
as
not?
I know, no. Because our processors are not, processors would not yield acceptable results, the volumes. So that
Okay.
someone could, so that someone should come here and invest.
Okay. What are the other efficiencies? Production efficiencies come through. Processes is one. What are the others? Efficient production process will result in what? Cost reductions. Very good. What are the factors that contribute to cost escalations?
Labor, energy,
Yeah,
financial costs.
yeah. Labor, energy, financial costs. What would basically reduce or create a lot of inefficiency? The reverse of it. What is the main aspect which creates a lot of inefficiency in the Sri Lankan context?
High energy cost.
Yeah. What has happened in the recent past? We boast about single-digit inflation, right? But looking at the history, the immediate past, immediate last 2-3 years, what has happened to our cost of living? It has gone up by how much? Your food bill prior to COVID would have been how much? If it was 10,000, what is it now? What has happened to your cost of living in this country? Triple. Inflation is down. Central bank is boasting, saying that they brought economy under control. Yes, they do. But what has happened to cost of living? Have they addressed that? Are you getting enough money for your expenses? So I'm basically coming into an FDI situation now through this. Why are people on the road? Huh? Sorting into trade union action. What are they asking?
Their income is not sufficient to match their expenditure.
Yeah. What are they asking? So therefore, salary increases, right?
Yes.
So how would that basically impact your efficiency of production? Cost of production will be lowered or increased as a result.
Cost of production will be increased, as well as the taxes will also be increased.
Exactly. Then what happens? Efficiency
reduces.
So you had to basically look at all these angles, you see. So currently what is happening in Sri Lanka is, it's safe to say that it's shifting towards creating inefficiency in our production processes because our cost of production is going up. We increased energy by 300% and reduced by 25% and saying we are reducing energy costs. Is that a real reduction? Comparatively, what should we be looking at if we are to basically attract investors into this country? We should look at energy costs of the other countries, the competing countries, right? So against them, if we are high, then we are inefficient against them. Right? So things that we can offer are also becoming, distant, or we are not going towards attracting FDI. So we have some problems. See, this is what I'm saying, practical application. We don't have a market. We have some resources. That also we are not giving in a value-added form, right? We may not have the oil and the timber and the whatever minerals. Minerals we do have, but then we have to have a strategy towards minerals. So if you are to basically look at these FDIs from a very critical angle, as against where, how are we doing as against where we should be? You need to be able to, get the theory, and theory basically tells you what the market is expecting from us. Are we in a position to do that? If we are, then well and good. If we are not, then that could be a reason why we are not getting into FDIs. Or maybe we don't want FDIs to come into the country because we are very happy with self-sufficiency. We don't want any of these fellows to come and mess up in our economy. So we basically take that internal approach. Right? So that also is one argument. So likewise, so I just created a question around it. I mean, seeing this slide. Okay. Then what are the other things? I mean, in addition to efficiencies, markets, and blah, blah, blah. I mean, if we have good trade arrangements with other countries, investors would love to come and exploit those trade arrangements like the SAFTAs and this, all the free trade agreements that we have with various countries vis-a-vis our competition. So likewise, you need to basically look at it in that context, in a practical context. Then the more trade barriers we have is detrimental to FDIs because they can't come and set up production processes here because there are lots of import restrictions and things like that. Unless you basically apply a different set of rules to those folks. Yeah. So that's how you basically look at those practical angles. When you study through these also, you go to the notes in that context. Okay. What are the possibilities? What are the practical possibilities from these questions? Vertical integration, product life cycle. Yeah, we did a lot of theory here. Then we came across some other key observations as well. Yeah. Yeah. So do you think that this is very theoretical? You looked at this, right? There was this assignment given to you. That's a very practical topic to have. Okay, what else? So this is that domestic debt capital, equity capital portion that we were talking about, diversification and optimal portfolio selection, correlations, risk reductions, all that, right? So there is a very empirical, using empirical data. It's a area of lot of practical use, right? Yeah, these are those hedge funds that we were talking about, then global financial systems. Yeah, so those are kind of then what we went through this forex markets and swaps. I think we basically hacked it to death. We spent a lot of time on this, and you know what we have asked in the past and so forth. So this is the intervention, sterilized intervention and unsterilized intervention. Yeah, this is that famous policy trilemma. Yeah, so that's basically that covers the whole discussion. Hope you got an understanding. If you have any questions, you can have. You have 1 more minute before the other lecture starts. Anything that you want to ask me specifically? I think I gave you a flavor of how I look at questions and how I look at your answers. Hope you